So vertical analysis then, we've talked about over time, and I think that everyone here can see how that's useful, even from a personal budget standpoint. If I can tell myself, wow, I spent $10,000 on groceries last year, but $30,000 this year, just from a management perspective, that's useful to know, right? That, oh, wow, my bills increased 20,000. What happened? Is it because coronavirus and the market went up? Or is it because I started eating out less? And so we can look at our personal budget from that perspective, and companies do the same thing. But then I might go to my friends and say, well, hey, did you spend an extra 200% on groceries this year? And they might all agree, or they might say that I really wasted my money. And so that's where companies are just doing the exact same thing, right? They're making those comparisons to make sure that they're on track with the norm, and hopefully doing better than the norm. But the next thing we can do is take vertical analysis. So vertical analysis, we're just taking the financial statement line items and comparing them to large groups, normally percentage of sales or percentage of assets. And so what are some normal comparisons, right? So I might want to compare my marketing expense to sales. I might want to compare my profitability to my sales. Or for my assets, I might want to compare my liabilities to my assets, right? See if I have enough assets to cover my liabilities. Enough current assets to cover my current liabilities, or break it out in different portions like that, right? So we should always have enough assets to cover our liabilities, or something's off in our financial statements, right? Assets equals liabilities plus equity. So vertical analysis, we're going to do the same kind of ratio. I'm not going to go over the math here other than in an example. So on balance sheet, normally we're comparing to total assets, and an income statement, we're comparing to revenue or net sales. And so revenue, we're going to compare to total revenue. So even though we have multiple periods here, we're going to compare against the current year, right? That's the whole change in vertical analysis. We're not comparing the change over the year, we're comparing the current year. So 520,000 divided by 520,000, we're always comparing against the revenue, is 100%. So out of that 520,000, how much did we spend on cost of sales? We just take the 360 divided by 520. That gets us our 69.2% here. And then for 2017, 315 divided by 480, that gets us our 65.6% here. And so this is useful, right? Because as our revenues increase, it might be difficult to see and compare how much our sales mix changed, or our cost mix changed. And so here we can see we actually spent more as a percentage of cost of sales on the revenue this year. And maybe that's because direct materials went up. That's maybe because we had to pay more for labor. But then we can go investigate that and see if there's anything we can do to control this cost, right? Companies make money by generating revenue and by controlling their costs. Selling admin, that's 24.7%. Instead of 26.3%. So again, that comparison was just done by 128,600 here, divided by 520 to get the 24.7%. We can keep doing that math, but I think it's relatively simple for the team. So 128,600 divided by here, we see that over the year, when compared to revenue, we're actually spending less on selling and administrative expense. And maybe that's a good thing, maybe that's a bad thing. Maybe if we spent more, we could have got more sales, but we can go investigate that and compare to other companies. And then we've decreased our interest expense. So we'll continue to do that. And then ultimately, we see that we've made 17,500 divided by 520, 3.4% of our net income from these revenues. And so this would be a little concerning that even though our revenues increased, our net income dropped. And why did that occur? It looks like the majority of that occurred because of the increase in the cost of sales. And so then we could go investigate. Generally, we don't want to make more sales and make less net income, right? So we can go investigate that matter. And we can see that clearly that our net income as a percentage of sales dropped by 0.6%, which is not what a company wants. So we can continue to do these assessments for revenue. You can also do it for assets as well, which we'll go into very specific examples for assets down the road. But for assets, we're more concerned with liabilities. As a percentage of liabilities of assets, are we able to pay our liabilities in a timely way?